Hello and welcome to Your Business, Your Wealth. I'm Cory Shepard, president of Sound Financial Group and co-host of this wonderful show. With me today is Paul. Eagles may soar, but honey badgers don't get sucked into jet engines. Adams with me for the part 4 of our Illusions of Investing series.
Now, Cory, I don't want to interrupt your role, but you have
But you-
see. Do you now see the pleasure of that intro, adding middle names or coming up with new stuff? Like, I am now getting a chance to experience the joy I'm sure you've experienced for the last year as I've introduced you on every episode. It makes me so happy.
Yes, and joy is what it has always been, that's for sure. And so we're going to have to flip coins for who gets to introduce who, I think, going forward, because yes, it is a lot of fun. So if you're just joining us for this episode, if you've never listened to the podcast before, you're just coming back, we're in the middle of a series called Illusions of Investing. Now, that's just fine that you're jumping here in the middle. You can listen to this episode and get a lot out of it by itself, but please go back and start at the beginning, because there's lots of great content here. And it's a recap of a series of conversations that Paul and I had back at the very beginning of our relationship when we first met, that led to us joining forces on this mission of bringing evidence and fact-based perspectives on investing into the world. And the whole reason that Paul and I are here in this partnership now years later is that he was able to help me see through these conversations some of the things that I had left uncovered or unhandled for my family, and by proxy for many of the clients that I was likely working with. And it quickly became a moral imperative for me to not be doing what I was doing in the way I was doing it, and start to help get this message out to the world. Paul's going to continue to do that for us today. Paul, take us away.
Right on. All of you are stepping in here, hopefully having already heard a little bit about the first 3 illusions of investing: stock picking and its ineffectiveness, track record investing, finding those people that were successful stock pickers at some point in the past and then trying to jump on their train, and how that doesn't correlate with success. And then we talked a little bit, what the F was the other one? Why am I blanking? What was the third one?
Market timing?
Market timing. Let me do that again.
Do you just want to take it?
Take it from the beginning, yeah. If you're just joining us now, we're going to get into illusion number 4 today, the cost of investing. But prior to this, what have we covered? Well, we've talked a little bit about stock picking, why stock picking doesn't work, why track record investing doesn't work, and why market timing doesn't work. Now, when I say they don't work, I don't mean that they never work. I mean that they don't work for you. And why they don't work for you is there's no way to consistently or predictably get returns in excess of the market using any of those strategies. And today we're going to cover down on the cost of investing. That so often when we invest, we don't think about the underlying cost and impact. Now, what is the cost of investing? These are fees incurred by investors to buy, sell, and own stocks or mutual funds. And the illusion is, well, if I don't see it, it's not really going to hurt me that bad. But there are underlying impacts to cost in your investment portfolio that you may not be aware of, in anything from your 401k to the Roth IRA that you opened just in time before you filed your taxes. So with that, let's just look first at what happens when we search this on Google. If you Google, in quotes, real cost of mutual funds, you will find the top article is an article from Forbes. Now, it may seem kind of funny to you that the latest article that ranks at the top of the Google search is an article written back in 2011. But one of the first things to notice is if you flip through Forbes, Inc., Entrepreneur, Money Magazine, Smart Money Magazine, any of these, it's astounding how many of the full-page color ads are actually from mutual fund companies. In fact, you go to the website for any of these Google results, and a tremendous amount of the advertising and the banners on the right, left, top, center, pop-ups are from where? They're from financial institutions offering to manage your money. As a result, these financial publications don't have a lot of interest in consistently sharing with you how expensive all of these platforms are. It's as if a car magazine continued to write articles about how a particular luxury brand had just been screwing up every car that came off the line and had all these incidental repairs and things that you shouldn't have to worry about. Well, that would cut off that entire luxury brand from advertising in Car and Driver. So you'll notice that they don't do things very often in any magazine that attacks or does a significant disservice to those who would advertise with them. So if you get a chance to look at this article, I'm going to give you a glimpse of it. We just kind of took the top of the article, the bottom, and fit it on a slide. But you can Google the real cost of owning mutual funds, and you'll actually find this article is the top result. Now, what they did in the article, which I thought boiled it down so simply, is they took the expense ratio, which is the thing that most people are familiar with. In this particular case, they came up with an average expense of 0.9%. So 0.9 of 1% for a set of actively managed equity-based mutual funds, but then they disclose some other costs. Some we're going to share with you more about here in a minute, but there's a cost called transaction cost. Transaction cost is the trading of the underlying stocks inside of a portfolio. Now, for years, and by the way, I'm not the only one who had this experience, for years, I always assumed that the mutual fund company paid for all their research and for all of their trading and everything out of that asset management fee that's disclosed. In this case, a little less than 1%, 0.90. Now, that is not the case at all. Our returns from a mutual fund are paid to us out of the net proceeds of every trade. So these asset managers are trading stocks inside the fund, and every time they do that, we get the net proceeds of that trade. But out of that trading, there's brokerage commissions and fees that have to be paid sometimes to an associated entity with the mutual funds and sometimes to an outside party. But the thing to consider is that there's just a huge chunk of cost that's not disclosed. On average, as a result of this study, it was 1.44%. So we have a 0.9 disclosed cost, then an additional 1.44% of transaction costs. Let me give you one more look inside transaction costs. Would be if that asset manager had to sell $10 million of, say, Microsoft, but after the trading is done, they net less than $10 million. For the sake of this conversation, I'm just going to say they net $9,995,000. Well, that's all that's reported to the mutual fund, but that extra chunk of money that had to go to the trading costs is a real cost. It's just not reported in the asset management fee. In fact, this is such a prevalent misbelief. Even in the advisor community, I had a gentleman I spoke to who'd been in the industry for 30 plus years. And I shared that with him. And he said, I'm fine with all the stuff you do, and I appreciate some of the training you do for our advisors, etc. But at the end of the day, I think you're just fear-mongering. That stuff isn't true. There isn't really all that extra cost in the mutual funds. And I said, I don't want to be disagreeable, but you're flatly wrong. He said, what do you mean I'm flatly wrong? I even, after watching your presentation, because we had done a group setting presentation, I went to unnamed mutual fund company, talked to somebody on the phone and said, is there any additional trading costs? And they said, no. I said, what you need to do is ask for a few managers up and they will give you the right answer. He says, I just don't believe it. So I said, well, which is your favorite one of their mutual funds? And he told me. I said, do you have a prospectus there? He said, yes. Now, I'm sometimes known as the Control F King, meaning hit Control F or Command F if you're a Mac user and quickly find stuff in a PDF document or a web page. So I quickly pulled up that prospectus on my end via PDF. He and I are chatting by phone. And I said, just turn to page, I think it was 14. I said, you see right there, it says trading costs are not reflected in the expense ratio. And it gave him pause. And he said, okay, I'm going to call them. And he did. And he asked for the managers like I had mentioned he should. And sure enough, they didn't report it inside the mutual fund the way he vehemently believed for over 3 decades. Now, here's the thing. when he was done with that, he has millions and millions and millions of dollars under management with this mutual fund company. Was he able to pivot and change his ways immediately? The cost isn't that big and their performance is okay anyway. It's valid. It's not what I would have done, but that's what's happening across the mutual fund marketplace and in the financial services industry. People are used to doing it the way they're doing it, and they don't acknowledge those costs. Now, there's one last cost that's reflected here on this slide and in that article, and that is something called cash drag. You see, most mutual funds are purchased not with any kind of rigor, but they're sold by the investment advisory community, bought by clients who oftentimes do not have the best behavior when markets are volatile. Because of that other investor behavior, and when you invest in one of these mutual funds, picture yourself like locking arms with a whole bunch of people your left and right that you're depending on them also, because you're in a mutual fund with them. All of you and your closest 150,000 friends have plopped your money into a mutual fund together, and you're counting on their behavior. Well, what kind of bad behavior would hurt your returns? Well, the first off is they know these people are more likely to have higher redemptions. Because they know they're going to have redemptions when markets are volatile, they keep a lot of money in cash. And it produces an additional drag on return in this study of about 0.83%. Now, that's not counting the tax cost if this is an investment that's outside of a retirement plan, which can be another 1% because of the way that they turn over the mutual fund in an attempt. Well, why do they turn over the mutual fund so much? They're attempting to outperform the market. And a little bit like somebody running with a parachute on, the harder you run while wearing the parachute, the higher the resistance gets. We know the more they trade, the more they increase trading costs. And in this case, that trading cost is 1.44, but the taxability of it can drag the returns by an extra percent. So if you had that mutual fund that you looked at and had 0.9% expense ratio, you might be paying 3.17% all in. And if it's in a non-qualified account, it might be 4% of cost a year. Now, if what you're hoping to get is an 8% rate of return year over year, that's a lot of drag to have to overcome. Now, it reminds me of a story of these two guys that are kind of from the backwoods. They had grown up and never really had much in the way of education. And these two cousins who lived in the country, lived together, had a pickup truck, and one of them went to community college. And he took a class on marketing. And he said, I have got the idea. Cletus, what we're going to do is we are going to buy a bunch of tomatoes and we are going to head to the farmer's market. And they said, oh, my goodness, what are we going to do there? He says, well, we're going to buy a bunch of these tomatoes for $1 each. We're going to drive them over to the farmer's market, sell them for $2 each. Now, that sounds like a pretty good idea. So they load up their pickup truck with a flat of tomatoes covering the bottom of the pickup truck, go to the farmer's market, sold them all. And he says, what are we going to do next week? And he says, I learned in my marketing class what we're going to do is we're going to load up a truckload with twice as many. And he says, we're just going to sell them for $1.50. He says, well, how are we going to make any money if we're only charging 50 cents? Before we were charging $2, they sold just fine. He says, we're going to make it up on volume. So Cletus says, all right, we'll do it. Sure enough, twice as many tomatoes, went to farmer's market, sold them all. Cletus thinks his cousin's a genius now. And he says, what are we going to do next weekend? He says, we're going to get twice as many again, sell them for $1.25. Cletus says, you sure? He says, yep, we're going to do it, and it's going to work because we've dropped the price again. So sure enough, they go, sold all their tomatoes. And then next weekend, goes to Cletus and says, here's what we're going to do. We're going to buy another double amount of tomatoes. And this time, we are going to sell them like crazy because we're going to sell them for 90 cents each. Cletus says, how in the world are we going to make money if we sell them for less than what we paid for them? And he says, keep in mind, I've been taking this marketing class. We're just going to make it up on volume. Now, that we know that you can't make it up on volume when you're losing money with each transaction. And yet, that tends to be what happens when active managers find themselves behind the 8 ball as it relates to returns, is they're attempting to trade more to outperform the market a little bit, like Cletus and his cousin trying to sell tomatoes. Now, when we come back after this short commercial break, we're going to talk a little bit about the bid-ask spread. Now, I try to pronounce that very clearly. It's the bid-ask spread. This is not an explicit episode of Your Business, Your Wealth. When we come back, I'm going to explain to you what that means and how it can drag on your returns. Hey everybody, I'm interrupting our show for a really important reason. We have a brand new white paper we're hoping you'll get value out of. Some of you actually might not even need the white paper. You might be ready to talk with Cory or I or our other team members about our philosophy. We'd be honored to do that with you, and it's in your control as to whether or not after that you would want to apply to become a client. We just want to impart more knowledge to you and make you better equipped to deal with the financial institutions and every offer that comes at you. But in the meanwhile, we also have this white paper that we want to give you, get in your hands to help be able to shift the way that you think about money. This white paper is going to show you 3 of the biggest mistakes we see people make and 6 ways to fix those mistakes to get you and your family on the most efficient track toward financial independence possible. You can get that by emailing us at info@sfgwa.com. That's info@sfgwa.com. And we'll look forward to hearing from you soon. We'll get it right out to you. We hope you read it. We hope it opens up your mind and puts you in a position to better be able to design and build a good life. Now back to our show. All right, right before break, I promised we would talk about the bid-ask spread. So in the market, there is the bid price for any individual stock, and that's what somebody says that they are willing to sell it for. And then there's the ask price, which is what somebody is saying they're willing to pay for a stock. And there's always a little spread between those. Now that bid-ask spread plus the mutual fund expenses make buying a mutual fund a little pricier than what we'd normally think, taking us back to that Forbes article we referenced. Well, let's say what somebody's going to do is sell a stock for $49.50. That's the price of the stock. Now, for the sake of this example, we're amplifying a little bit what the cost is of the market maker, but there is a market maker, and this exists on every stock exchange, where there is somebody that provides liquidity in the market and facilitates the transaction. That results in brokerage costs or just the difference between the bid and the ask. And that bid-ask spread, if the purchase price is $50, then we only netted, if our portfolio is selling the stock for $49.50, we technically sold it for $50, but the market maker made that 50 cents. Now, this is relatively small when you're trading in highly liquid, highly traded companies, such as those in the Standard & Poor's 500 index. But where it gets more difficult and more important to not have the stocks trade too much is when you assess it, especially in international markets and in small cap stocks. Now, we've talked about on the show before how small cap stocks have a premium. They get a little bit extra return in exchange for the little bit of extra volatility they are. But there's also a bigger market maker spread in each of those transactions because it's a relatively less liquid market than, say, US large cap stocks. So that's the way that those transaction costs stack up inside an investment. And we don't see it in the expense ratio, where it shows up as just drag on return. Now, I'm going to be showing a graph here for those of you that are listening, but I'll summarize this graph we're looking at. And that is that the higher the trading done in any mutual fund, the higher what they call their turnover ratio. If you have a 100% turnover ratio, that means effectively they've done as many trades to trade in volume the same as the entire value of the mutual fund. So the higher the turnover, the less likely it is they are going to win or outperform the index that they're being compared to. So if you have an average turnover of 17% or less, you put yourself in the position that you're more likely to outperform than those high turnover ratio investments like 100% plus in turnover. In fact, it's nearly twice as likely over long periods of time that those higher turnover funds are going to be able to outperform the index that they're being compared to. And let's say one of the things that you've bought into or accept is I'd rather just be in totally no-load mutual funds. I'm not worried about any of that. I do no-load mutual funds because I don't want any sales charge or asset management fees. But in and of itself, going no-load isn't enough. We're going to go back and reference one more quote from Charlie Ellis from our last episode, where we watched him talk about the inability for individuals to beat those who are at the highest trading volumes in the market. But when he talked about no-load mutual funds, he said the key question is, under the new rules of the game, how much better must the active manager be just to recover the cost of their active management? The answer is daunting, meaning that forget the charge on the mutual fund, the asset management fee, that if the mutual fund manager, the active manager, is attempting to trade their way to success, it's actually less likely they can even outperform the cost that they created by doing all of the trading in an attempt to outperform the market. What we want to watch is, and what you can take away from this episode is, I don't know, go do a Google search on the mutual funds you currently have. Look at their turnover ratios. And if you find those turnover ratios are higher, you're probably having some of this, what I might refer to as parasitic drag on your investments, making it harder for them to outperform the market and certainly harder for them to put you in the position to be at definite financial independence to fund your work optional lifestyle. So let's talk about bonus illusion number 5. That's something I can't say 3 times fast, is letting them handle it. This is the idea that I feel like I can simply allow someone to select and manage my investments, and they're just going to let me know if anything changes. The real illusion is that your future is going to work out with somebody else at the helm. Now, when put that way, it really makes sense almost immediately that it's probably not going to work out if you're not driving it. And yet, what happens when you have somebody do something where you've given no clear conditions of satisfaction? That's the definition of abdicating, like, oh, you go handle that, let me know how it goes. But when you don't give them the conditions of satisfaction, there's only 2 outcomes. One is that they did what they were supposed to do. And then what do? Just like, they're like, say it's a spouse or your CPA who's helping make all those decisions. And you look at them, you're like, well, that's what you're supposed to do. We're supposed to retire successfully. What do you want? A cookie? Or you're unhappy. And you're unhappy because the future didn't work out. And people wonder why it is. There's so many people north of the age of 60 that are getting divorced. Now, I show you this picture of this man and woman in their early 60s hugging near the water's edge. Picture them out on a boat right now. Now, there's one of 2 things happening. She might be eternally grateful because he did everything he was supposed to do, and she just abdicated to him all these years, and fortunately it worked out. Or it didn't work out that well. They don't have enough money coming in, and she's getting ready to choke him out and throw him into a cold ocean so that at least there's just one person left to depend on the income forever. You see, we need to make sure that we are responsible for our financial future, and that includes if your spouse is handling some of it. Let me put it in a different term for you. You've heard me talk about this before on our show, but it's the idea of if one spouse, which we hear all the time, at the beginning of our process, one spouse says, well, I don't really deal with the money stuff. I don't find it that interesting. He or she is the one that handles all of that. Well, here's the problem. Imagine saying that about your children. Now, we know this is a crazy thing to say. Hey, listen, kids are fine. I'm not a huge fan. I do better with teenagers. So how about you just raise them until they're about 13? I'm not really going to have a lot of input. I'll interface with them later on. Now, we know that doesn't work from a parenting perspective. Now, we relate to that very easily because we know our children are an inevitable part of our future. But so is your money. So the lesson to this illusion is we have to be responsible, and we'll talk more about that in our next episode. But let's do a quick review of all these illusions. Very simply, people think they can stock pick. People think they can choose asset managers based upon their track record. People feel like maybe they can market time. The market's high, it might be the time to get out. People underestimate the cost of investing. And last but not least, they often abdicate to a spouse or some outside party to quote unquote make the decisions because I trust you rather than being wholly responsible for it. So in our next episode, we're going to talk about passive structured investing and what that means, and specifically how Sound Financial Group starts to tackle some of these illusions to put our clients in the driver's seat as it relates to their money. So I look forward to seeing you in our next episode, and we hope that this has been a contribution to you being able to design and build a good life. Hey everyone, thanks for watching. Be sure to subscribe, ring that bell, and when you get a moment, pick up my book on Amazon, Sound Financial Advice. It's the kind of book that's easy to read, but hard to forget all the knowledge you learned.